Bill, do you want to say a little bit about yourself to Scott? And then Scott, do you want to say a little bit about yourself to Bill?
Perfect, perfect. I spent the majority of my career, Scott, in the music and entertainment industry. 18 years of age, started in the warehouse of Warner Brothers. 27, became president and CEO of Virgin Records. In 2001, at 32, moved over to Sony as the senior vice president and general manager, and I co-ran Sony Entertainment. In '04, the world figured out how to download music for free, and we saw the writing was on the wall, so it was time to move on. So I moved off and became a consultant to the entertainment industry. 2009, kind of pivoted the consulting business to help entrepreneurs and startup companies. And over the last, I guess, about a year and a half now, I came across a company out of Quebec in Canada that was kind of a really unique entrepreneurial incubator that, for the most part, did everything to help entrepreneurs and give them, ongoing support rather than just a check. And so I've been in the process of acquiring that company and added another division to it, which is called Unicube Financial Services, where we're selling 2 financial products to entrepreneurs for capital raise, for scaling businesses, that sort of thing. And having a blast. And here we are.
All right, terrific. Thank you for that. Appreciate it. Just a quick background on my side.
Scott, I apologize. And when Jeff comes back, because I know he logged in, he just put his, oh, there we go. There's Jeff.
Jeff, state, don't move.
Right. Great. Scott, now you can continue because I really wanted Jeff to hear about you and your background, if that's all right.
All right. So Jeff is on, is that correct?
Yep, I'm here.
Okay. All right, perfect. That's great. So I'm a former Series 7, 63, 65. So actually, before that, I went to University of Chicago thinking that I was going to be an economist, PhD. Ended up dropping out before my PhD program, but to get my master's. So I was on the finance side as an investment advisor for some time, working on wealth management. I eventually moved over to the tech side. Eventually became GM and VP of product management at a Silicon Valley startup. Helped pioneer what's called the robo-advisor category in the late 2000s. Sold that company to Pfizer, transitioned to investing and venture capital, really focusing on lately more smart city technologies, IoT data, clean energy, storage, and so forth. So I'm one of probably the foremost thought leader when it comes to smart cities and innovation. I've been doing quite a bit of advising on technology. So in a given year, looking at several hundred startups. I'm currently advising Loyal VC, where they have about 90 portfolio startups, and then other venture capital firms as well. So I do due diligence on a range of startups very early, but also late stage, such as Outreach, which was a Series Z, raised $239 million as an example. Go Carless, another Series Z company. And a few years back, I was recruited by Samson Ventures, helped them with some due diligence that led to the acquisition of Viv, which is a virtual assistant startup, for $250 million. I've also advised Samson on the future of product portfolios, such as the human-machine interfaces that's going to emerge after the smartphone. Some of the work that they're doing around modular micro-LED TV and other products I've also advised as well. And I serve as a VC judge at South by Southwest Pitch, Startup World Cup, Emerge Ivy League Startup Competition, Singularity University Smart City Accelerator, as well as other competitions as a VC judge. So that's a little bit about myself.
Very cool.
Jeff, tell us a little bit about you.
Well, can you hear me okay?
Absolutely.
I'm getting some kind of weird noise coming out of the computer. I don't know what's going on. Apologize for a second. So for me, I bought and sold about 250 companies in my career, about 25 billion in transactions. I've been a Fortune 100 officer. I've been had my own primetime television show on Bloomberg. I was a judge on Celebrity Apprentice for 3 years. Producer, helped come up with the show. And now I lead C-Suite Network. We have about 350,000 C-Suite executives that are part of our program. We have 157 podcast shows. We've got 48 waiting to go live any day now. We'll be at about 300 podcast shows by the end of this year for sure. We're adding a new podcast show about every other day at this point. And so we're the world's largest business podcast network. We have C-Suite radios. We own C-Suite TV. We have 70 TV shows. We're on Apple, Roku, Amazon Live. We're primarily focused just on getting content out to executives. That's what we do. That's a big part of everything that we do inside the C-Suite network. And so we have C-Suite advisors, C-Suite book club. Our advisors are coaches, trainers, authors, speakers. So we provide a forum for them to be able to get their content out and participate in our network. So that's what we do.
I have 0 shares in Jeff's company. I was part of a webinar he did a little bit earlier today, and he had nothing but success stories after success stories after success stories. And from the people in Jeff's team that he's introduced me to, they've just been a pleasure to work with.
Well, thank you very much. Yeah, the team that we have in our team, I mean, I've got everybody that used to be the CMO of a $3 billion ad holding company, that ran business development for major companies of 150, 160 billion. So startup, everything from startups to billion-dollar companies. That's what we help to try to do. We primarily focus most of ours on mid-cap or larger small businesses, and then up to mid-cap is our sweet spot. We do have we have 21% of our audience or group is billion-dollar company, 27% are 100 million to a billion, and 51% under 100 million.
Awesome. Thank you. Person who couldn't be here today, but I want to just take 2 seconds and introduce him, is Josh Blair. Josh was president, group president, chief operating officer of TELUS. In Canada, TELUS is your version of Verizon. They're a telecommunication company. And today he's the chair of TELUS International. What you don't know about Josh is he's also a venture capitalist and a philanthropist, and just a pleasure to work with. And I'm sorry Josh couldn't be here today. And I'm going to pretend I'm Josh. Do the best I can. Awesome. So here's Jeff. Here's why
I can add just one word, because I talked to Josh like last week, first time, and he's a really brilliant person. Just for you to know.
Please. Yeah, thank you. Jeff, here's why we're having a call today. Last time you, me, and Opher were together, Jeff, we were talking about Avengers, how we designed the board of directors, or not board of, we were thinking about how do we go ahead and design the Avengers program. Jeff, you were key and instrumental in reaching out to the network and getting me a list of people who've done 4 exits or more, humble human beings. And I'm happy to say we've recruited a few of them. And I'll give you the details on that some other time, if I may. Opher was kind enough to introduce me to Scott. I thought Scott was just a brilliant guy. Opher said, I'm going to introduce you to a guy called Scott. Your job is to recruit him and make sure he's part of the team. I have no idea who this Scott is. I'm going to have a chat with him. And then, as I mentioned, the Avengers program to Scott, he grilled and he grilled and he grilled and he grilled me on every assumption we have made in our last call with you, Jeff. And then I figured by the end of the call, I said, okay, clearly we didn't think everything through. And then Jeff, you, me, and Opher and Bill haven't got together for a while, so I thought we should get together and I should invite Scott to the call and get Scott to share some of his observations with us, and I thought it was some learnings out of it. I also think that Scott's a really super smart guy, and I think for all of us to know Scott is a good thing to do anyway, regardless of that, like a side effect to this conversation. And so here we are, having a quick, smart conversation. So Scott, thanks for being here. Jeff, thanks for being here. Here's a conversation I had, Jeff, when you, me, and Opher and Bill were together. Jeff, you said, let's go get a bunch of Avengers together. Opher said they should have done minimum 4 exits or more. And then Jeff, what you specifically said is they should be humble human beings. And then you said, let's go and create a list of, we all have 5 names, put it on a board, and then we'll reach out to them, if you remember that conversation. And then we all went and did that, Jeff. You were kind enough to actually reach out to, I think, a little bit more than 5 people, and I'm grateful for that. And then I bumped into Scott, and then why don't I just shut up from there? And then Scott, you tell me you had a whole bunch of ideas and some things that you thought that we should talk about, and I'd love to just keep quiet here.
Well, first of all,
since you don't have your camera on, if you don't mind, I'm just going to put your picture up here so people
yeah, that's fine.
get the visual, if that's okay with you.
Well, just to put a disclaimer that I certainly didn't set the agenda for this meeting. I think it's more out of curiosity than anything else that I certainly don't have the answers. I'm really looking for answers or just get some more information in terms of what you guys are looking to achieve. And certainly I don't want this to be, my soapbox. That certainly wasn't my intent. So I just want to set that. Maybe a good starting point is if the team can help, me understand in terms of what was the genesis and what are the end results that you guys are looking to achieve.
Minas, you want to go first?
You want me to say?
Yeah.
Mm-hmm. The first concept was having, let's call it a board of advisors for the sake of understanding, that can choose. Let's say there are 12 people in the board of advisors. Some of them are people who made at least, that's what we had in mind, 4 exits of a total of $1 billion. And so basically they have the experience. They must not be the CEOs of the companies. They could have been like vice president of marketing or vice president of finance. However, they've worked in 4 continuous companies, so that kind of serial, not entrepreneurs, but the serial in the way that they have been able to take again and again companies into through exit strategy to an exit. The idea was to have like around 8 experts who have this experience. And the second part is that to have 2 people who have been working on the acquisition part for VCs, for like VC organizations. They know how to, to invest and buy and sell companies. And then other 2 people we wanted to have are those who are doing acquisition for the large companies, like somebody who's been working on an acquisition in Intel or some other big company that buys a lot of startups. So having the group of 12 with their experience is to help them to choose 12 different startups, because we assume that those people, they know how to choose because they have been choosing right before, because they had 4 exits and they're capable of being on the board of these 12 companies. Choose 12 companies, try to get 8 of them into exits of some kind within, if possible, 3 years, and if not, it will be more. The most important part is not the exits. It's not the ability to invest in on the right companies and bring them to the position of selling. The most important part is finding the best practices which are inside the brain of these 12 people, which means most people that build a company once in their life and sell it, you could say they have some ability, but you can also add luck into that. And I've seen people are building one company and failing again and again in the next 5 or 6 companies. So there are serial failures besides of one that they've been able to do it the first time. Some of the serial entrepreneurs that I've been working with have been able to sell 6 companies, 7 companies, 8 companies again and again, building a one and selling, building and selling, building and selling, and failing, of course, but being able to sell many of them. They have what we call unique talent of some kind. Sometimes they even cannot explain how they do it. They have the intuition. They told me all the time, every company is something unique. It's totally different every time, again and again. I cannot tell you what is the common denominator between those processes. However, for sure, there is a common denominator. And what the thought was is to have those 12 brilliant people working with 12 startups and to follow every decision-making point, okay, in the next 3 years or 4 years, analyzing how those 12 people, the 12 Avengers, are making decisions, in what way, to record every element of conversation between them and the startups, to transcribe everything, to analyze everything, to have a data analyst working on it, until we can define a methodology. The moment we can define a methodology of how the 12 talents are doing their work, including proving that they can sell those 8 companies or 7 companies, whatever we'll get out of 12, within 1 or 3 years, we'll have their unique talent being transcribed into a methodology. Now, we can stay at that point just writing a book about it and selling 8 companies, and each one of us will get a percentage, in shares in each company. But that's not the main idea. The main idea is to extract those unique talents from each one of you, analyze it, and create a methodology that will be defined as some kind of AI technology later on. Your brain into AI, plus, of course, the human side. It's not only AI, okay? And with this concept is to define something that will enable 2 sides of the coin succeed better in the future. We know that a lot of investors, when they invest, let's say, in 10 companies, they might sell one of them and get all the money from all the 10 companies they invested, because they will sell it, let's say, for 1 billion. So if they lost $500 million, it's not so bad. However, investors are, and I can see it now in Israel in the past 2 years, Israel, the startup nation, people are holding their investments in startups because it became too risky. So it's not easy to get money now for startups as it was like 5 years ago. And the reason is because nobody is sure that this startup will succeed. Okay? Now, if we have all this methodology written down and implemented in some AI format, and you invite now startups from all over the world to work on this platform, and this platform will check every decision-making point, whether it's marketing or development or what computer language we use, who is the best talent as a developer, senior developers, junior developers, everything that is happening, the business model, analyzing the business models. Now imagine there's a platform sitting on an IBM or something, right? And you have 2,000 startups coming in. When they come in, the machine can analyze and provide them the right processes to work in order to succeed. Now, let's assume we're capable of doing this, as well as having, board of directors around them, which we can build in the future. And there will be all of them on one platform working on their startups. So it's basically could be like a hub, or maybe the biggest hub in the world, that everything is being done in a SaaS form, like online, okay? And people come, you can find the best talents in the world for marketing, the best talents in the world for anything else, coming, being enhanced, being coached daily by a system that I have developed to coach them daily based on the best practices that we would define in our process, and make them more successful. Now, here comes the other side of the game, investors. Today, an investor is being approached, let's say, at least on before they go to VCs, then the first, investment is somebody who will give $2 million or $3 million to a company, and then he takes some accountants that will check the company, what is possible, not possible, is it possible, but it's still guesswork. It's still a pitch deck, and it's still a presentation, and it's still some business model that might not work in 80% of the cases. So now, on that platform, we know which startup is working and how they're working, who of them is going to be successful or not, and we can raise the level of success, let's say, by 30%, which is a lot. Now, the investors come in and we tell them, guys, you can invest in those startups, but now you have to pay in order to get the data, the one pager that we will create for you based on AI about each startup, which means you will be based your investments on data, not on promises. If today you invest in the beginning mostly on promises and some market analysis and so on and so on, there will be data, and you will have the data. And so as an investor, you might pay maybe $100,000 just to get the data of 2,000 startups which are on the platform. And then if you want to know more about each startups, you will have to pay even more about it. And I can see a huge business model around that, okay, of probably whether hundreds of millions of dollars or more, that will enable the investors to lower their risk by 30% and to higher the success rate of startup by 30%, which is a lot if it's possible. So the first initial model that I've worked with Taimour was about it. How can we bring it to the point that we have the methodology, implement it into some kind of technology, including human side on it, like board of directors and so on, and have all investors come in and less risking. Also, if you have a platform with a lot of startups inside, then you can do like the Amazon model, say. So if you want to invest in this kind of a startup, we have other 6 startups like this, and maybe you want to buy 2 of them and mix them together into one startup, that you have a better product or whatever it is. This is the basic model. There are a lot of questions how to do it. My part is only the methodology. All the rest will be done by other people. And Taimour said that there is a way to subsidize or to invest in those startups with some financial models that Taimour is dealing with. And the only thing we need for now is some kind of process to get to the point that we have a nice business model around what we're doing and a business process that will work, and start to do this, to go into the process and start to record every communication, every WhatsApp, that will be between us as the board and the startups as companies and CEOs of the company and so on, and analyze everything. The analysis will be conducted by data analysts and some other people in different fields and different experts. And I want to conduct the methodology part that will enable us to have a precise methodology for it. This is kind of the overview of the process. If you have any questions, I'm willing to answer. Jeff? No. Anybody has a question?
No, I'm still here. I know. I've been through this program before.
Same here.
So I think the first comment that I would provide is there's already a fairly robust startup founded by some really esteemed AI professors and researchers, really top-notch experts in this field. And what they've done is they've really applied crowdsourcing plus artificial intelligence specifically to address this problem. Now they're focusing on the area that has the greatest degree of asymmetric information, which is the early stage. So things that are seed and pre-seed versus, let's say, institutional rounds A and above. And the way that works is, true to crowdsourcing, it doesn't rely on just tribe of 12, but it relies on a larger set of participants. So for every startup, there is a assignment to a certain number of, let's say, experts. They could be VCs, angels, operators, and EIRs, and so forth, based on their own set of best practices and intrinsic sets of due diligence measurements. They will evaluate a startup, again, in pre-seed stage. Based on that, the system starts to understand how they're assessing, evaluating the risk and reward characteristics of that particular startup. And moreover, they're also providing some sort of weights, coefficient assigned to each of the evaluators as well, to see if in fact how good each of the evaluators are in having that predictive confidence degree in subsequent rounds. Now, this methodology that they've developed has shown that 90% or greater of those startups that pass through this crowdsourcing plus AI mechanism gets the next round of venture funding. It's been so successful that they're actually looking to increase their data sets to go into other levels of stages and other asset classes. I know for a fact that even countries, for example, specifically the nation of Japan, was having the same question around how do we determine out of this pool of potential investment opportunities, which one do we systematically pursue? So they wanted to be able to start to allow this set of algorithms to train off their data sets and be able to help rejuvenate, because Japan is highly risk averse and very conservative, and really, aside from SoftBank, tends to not know how to really do due diligence very well. So they're applying this to a great extent already, and certainly the data is there as well. So there's a lot of questions just in that category alone, but I want to parking lot that. I want to come back and ask a question around what is the incentive for each of the stakeholders in this group and others that you bring on trying to achieve? In other words, are you guys looking to increase your net worth? And can you do that outside of this context, or do you need this context to be able to multiply and amplify that net worth? So I'm just trying to understand what is the draw, what are the individual motivations, and the specific takeaways that you want out of this collaboration.
Okay. Anyone wants to start?
Scott, I've talked to a few of the what's called the venture, and I think we've been successful recruiting a few of them. Opher, you stop me if you think your understanding is different than mine. I would say there are many reasons why the ones who've said put up their hand. There are many reasons why they're kind of interested in participating. One is access to funding. I think that was a big draw for them. Second one is the access to who's at the table. It occurs to me that none of them had an execution, or none of them had a strategy problem, but they wanted to leverage each other's networks so they can execute faster. I think the third one, and this is not something that I heard directly, but I would probably say indirectly, would be leadership training and development, the ability to learn from people around the table. Honestly, I know because I just participated in Jeff's webinar. He doesn't like the word mastermind.
Right.
Jeff, I don't know what the word is I should use right now.
Peer-to-peer councils.
Peer-to-peer council. Scott, my little 2 cents is capital and the benefits that comes in a peer-to-peer funding and the benefit that comes into peer-to-peer council. Opher, you tell me if you think I'm incorrect.
Yeah, I agree. Yeah, I have different motivation, but yeah. I have a totally different motivation, Scott. But I will talk in the end.
Yeah, I think the question that I'm really asking is, it's an identity crisis. So is this an angel network club? Is this a venture capital firm? Is this a board of director of a conglomerate? Or is this a pure networking consortium? So I think really the key question is, what is the identity of this institution and what are the outcomes that you want to achieve? If one of the objectives is capital raise or are there other means to raise capital than by having 12 veterans who have raised capital? Do they need others to be able to raise capital? Wouldn't they already be in a position to raise capital on their own? And how much capital are we looking at? Is this $1 billion fund or is this a $100 million fund? So I'm still not clear in terms of the identity of this organization. What are you looking to achieve that you won't be able to achieve on your own?
That's a great question that I honestly haven't thought about that. So thank you for bringing that up. And when you, like, this is why I invited you to be on the call, because I figured if I have Jeff, Bill, and Opher, that would be an answer we could come up with. But in terms of the fund, the number we came up with was $60 million. And I can give you the logic around the 60 million, but I'd rather solve the identity question, if I may.
You're throwing that out to all of us, Taimour?
Yeah.
Yeah, I mean, to me, this is like a sequoia effect. It's very much like a giant sequoia tree, and underneath that canopy is this ecosystem that evolves and has a place that this lush environment. So if you look at other types of plays like that, whether it be LinkedIn or whether it be Facebook, but certainly, you know, some of the VC firms themselves have that a little bit, although they typically, as do private equity firms to some extent, but they typically don't build out the other assets and the other pieces that you need under that environment to really create the marketplace to assure that they have success. Now they'll pivot in and pivot out. They'll parachute in and parachute out, but they're not providing an overall environment or community where everybody can play. And then on top of it, that being able to take that and monetize that across the board through the data and the predictability of what we start to build, it's going to be one of the safest bets most people can make with their money. That's where I see that play. Scott, that was Jeff Hazlett, by the way.
The one thing that I would add to that, if I may, and Jeff, that was awesome, is we've been asking people to consider giving the entire organization 20% equity. So let's just say Bill came in to the project as an venture. Bill would give 20% equity to the whole team, including all of us around this table. And then the next guy coming in, he's putting 20% for all of us at that. And so even if 3 of them exit from whatever this so-called program is, the whole group would benefit from it.
This is the short-term benefit, of course.
It's the short-term benefit. And I'm not sure that's something they could do by themselves. And I don't know, Scott, now linking back to you, I don't know what this is. You're right, the identity thing.
So if you look at some of the past reports that came out of Kaufman Institution around some of the early VC work and the data, if you look at accelerators as an example, most of them actually produce dismal to negative results, and because they're private, it's difficult to ascertain the true hits and the home runs that they actually have. The handful that actually do consistently produce great results is Y Combinator and Techstar. And I have spoken to many alumni of Y Combinator as an example. One of the key things that if I were to do a multivariate regression, is this notion around market fit. Is when many are focusing on the paper, the demos, the presentations, and some of those things, from day one, they're expected to go out, knock on doors, make calls, and try to get as quickly to market fit as much as possible. Their obsession around market fit is really what distinctively sets them apart, aside from the selective process. And it's interesting because the notion of ecosystem it's a bit of a kind of a ideology in the sense of, to have great successes, it actually requires exclusivity. But if you want to have many successes but lower hits and mediocre or moderate results, we can actually increase the scale of that. So I think one of the things as part of the identity is trying to understand, do you want the guard to be very large but moderate? So I know a fund that's returning IRR of 7%, is that acceptable? But you're affecting hundreds and hundreds of startups and effectively creating jobs and creating new sectors and so forth. Or do you want to be, returning 10,000, 50,000 returns, IRRs, but again, it's only for a handful of potentially successful events. The issue that I have with the ecosystem model is there are lots of competing paradigms that are out there. One of the trends that we're seeing is venture studios. Because of the challenge of innovation, especially within blue chips, they have their labs, but in addition to their labs, they're actually endowing these venture studios to innovate on their behalf. So the venture studios work as a quasi-hybrid professional services, but also a VC that has an equity position in it. Bain has it, BCG has it, a lot of others. Techstar, I think, has it as well. And then certainly the accelerator and that ecosystem model is trying to develop that ecosystem. So ERA out of New York, for instance, have about, they claim, I think, 300 or 800 mentors. Part of the reason they're able to scale and represent their ERA accelerator, not just for New York, but represented for the country of Korea, country of, I think, Sweden, country of Japan, and many other countries as their kind of foothold into the US, is because of their ability to create this ecosystem, both on the mentorship, but also the buying side as well. Because one of the key aspects of execution is the initial market fit, the pilots, and the distribution. And then of course, what's really interesting these days is the new paradigm around where are the VC model going? And so one of those interesting models that's cropping up is they're not a traditional VC. They do not take an equity position, but they identify, in particularly SaaS e-commerce types of models, where if you get the microeconomic transaction right, and you accelerate the input of cash flow, you know exactly what the output is going to be because the microeconomic is consistent. So in those situations, it's a pure revenue share model. And they're just simply providing 10, 20, $30 million, not taking equity position, but a revenue share model, which solves the principal agency problem that typically happens with VCs and startups. And then to compound that paradigm shift, we're also seeing the issuance of ICOs and SCOs, the initial coin offerings, security coin offerings, and how those entities, although they're being subject to more rigor and regulation, are ultimately trying to bypass the traditional VC ecosystem altogether by going to a funding mechanism that's more crowdsourced. So I think one of the things we have to really think through is, this isn't new. So what is the comparative advantage and the uniqueness of this organization and the collective members that cannot be replicated elsewhere?
I can answer it. Since I know Y Combinator and other organizations like this, they have some best practices put down, they have some courses, but mostly what they do is mentoring, which means that maybe we'll get a good mentor, a less good mentor, I can be a mentor, Jeffrey can be a mentor, and Bill Bannum can become a mentor, but it's not systemized in the matter of a precise methodology. It can be set up as a measurement system online to measure every aspect. It means like, okay, you have a startup and you'll get some mentors, and one of them is in finance, and one of them is about marketing, and one of them is about maybe development, and but it's only on the level of mentoring. And since I've been in that business of mentoring and coaching, and I know that it's not precise model. And when you have a precise methodology, it's totally different. And when some of the part of the methodology is scripted, okay, on a technology platform, and you go through the process step by step, and the machine can check everything that you do, basing it on another 2,000 or 4,000 or 10,000 startups that you have on the system, and based on a lot of analysis of the market, this is not a Y Combinator. I mean, I know Y Combinator, they had some success, by the way, not a lot, okay, but some nice success, but it's based on here and there mentoring. So they will hire Bill, or they will hire me, or they will hire somebody else to do some mentoring for the companies, which is great because those mentors, but there is no a methodology that extracted this precise model of how Jeffrey's mind's working, selling 250 companies, and what Bill has in his brain as a CEO of large companies or whatever he has done, and what Taimour has in his brain as a financial expert, and what Josh has running one of the like a large company of technology. I need those people to analyze their personal operating system and to combine it into one brain that will sit on a technology platform, and that brain will support and every step, I'm saying on the micro level steps of startups, all the advice and all the decision-making processes and I mean like algorithms that you can put all the information, it will help you to assess your position and whatever. So I've not seen yet a technology-based methodology on that level, which I believe that the world will need from now on, that will enable also to create a much better belief system based on this data and expertise for the investor. It's not about mentoring, okay? It's about a precise methodology of unique brains into the machine. And by the way, as long as each company will have its own board of advisors over time, will continue to aggregate the data with some machine learning process in order to learn what every startup is doing, how they become successful, why 2,000 of them succeeded or not succeeded, as well as every interaction in the future that will be inside the startup, because it will be on one platform that will communicate. We will analyze it with machine learning so we can create even better best practices in the future. So this is just a little bit the difference, I believe, between what Y Combinator or Star, Techstar, or whatever they're doing, and this process. This is an AI based on methodology system that will refine itself forever, okay, with the expertise inside, and will create this algorithms. The thinking algorithms will be taken into computer algorithms to assess every step in a startup, like how to define who you're going to take as an employee, how is it working, is it productive, is it not productive, creative solutions, whoever we need. Do we need another expert in our field? Where can we find it on our system? And maybe like a startup was sold, we know that there were some employees there. One of them is excellent for that startup. We can sell him or approach him to another startup because he has this unique ability that those startups, they don't know. There's a guy with unique ability here in Israel, and nobody, okay, in Switzerland heard about him. So they're all going to be in a large system that will enable them to go through measurements and precise advice that will aggregate over time to even better solutions. This is how I see it.
So one of the things that I anecdotally have observed is the notion of network effect. I'm involved with an organization called Merge, which is a acceleration platform that is representing all the Ivy Leagues in the country. And I've had the opportunity to be on the panel of VCs in terms of evaluating some of these startups. And what was very interesting is there is a marked difference between those startups coming out of, let's say, Harvard or Penn or Princeton or Columbia versus, let's say, I don't know. I mean, I went to the University of Chicago. We're really more nerds than anything else. But, let's take Georgia Tech as an example. And what I've seen is that even if you keep everything constant, ceteris paribus, if you keep everything constant in terms of skill set, aptitude, experience, what is a differentiating factor is a network effect. To give you an example, there was a Harvard startup where they're focusing on sustainable, quick meals. So it's a CPG play, and they're trying to create a new paradigm within the ramen noodle category. Because quick ready meals in packages is a really readily hot thing these days, especially niche brands that appeal to millennials and Gen Zs. So they've figured out a sourcing method from, I think, Japan, where they can actually get sustainable, good, healthy alternative to the usual unhealthy, typical ramen noodles. One of the things I noticed that made her distinctively interesting wasn't necessarily that, you know, she had a superior intellect or superior business approach, but it was about her network. She was able to access Walmart and Whole Foods directly at the board of director level because of the fact that she was able to tap into the Harvard alumni, as an example. Whereas a comparable with equal business paradigm did not necessarily have that network effect. And I think one of the distinctive aspects I think this group brings, my sense, is that network effect. I don't, please correct me if I'm wrong, I don't think this group is a type that would roll up their sleeve and say, okay, I'm ready to start from the ground zero with a brand new startup, putting in 150 hours a week. Rather, it's about, you know, they can help and assist and to network and to amplify the growth of that particular startup. So that's a comment.
Well,
that I have.
Okay, Scott, jump in. Not just about startups. Let's take any business. I mean, Taimour called me today. I got a company that has a solution for this, for the virus, about this. Jeff, I need these. I need somebody. Boom. We'll talk today and figure that. Or, you know, I'll give you an example. A week and a half ago, I got a call from the government saying it's Saturday. We can't get a hold of any hotel because they've all shut down. And we need to know the owners of hotels in New York City so that we can turn them into hospitals. But within 24 hours, I had them 9 hospitals or 9 hotels that they're turning into hospitals. And I said, oh, by the way, why aren't you calling the damn cruise lines? They got empty boats, park them outside in the harbor, and they go, well, how do we get a hold of them? So I pick up the phone and call the CMO for Carnival, and 2 days later, they're bringing the ships into the harbor.
Exactly.
Same thing.
That's right.
Yeah.
That's right. So that's a beautiful, absolutely right on. So I think one of the questions I think I had asked Taimour is because I think I heard something around some sort of a liquidity event within 3 years, which means that, are we saying the group is going to invest into pre-existing operating ventures with the expectation of an exit in 3 years, or is this a brand new venture that gets started from the ground up, much like Rocket Internet in Europe, as an example? You know, I think from an insertion where this group can add tremendous value is not necessarily in the seed, pre-seed, or even Series A, but rather it's more like Series C. It's preparing for that either longer private journey or eventually to pre-IPO, and they need the firepower, exactly what you just said, to be able to make those connections and bridge and to be able to distribute that, frankly, the initial founding team could not have. So I think that's part of the kind of the identity aspect. The other aspect that I want to kind of ask about is, I think I heard $60 million capitalization. What exactly does that mean, and what kind of firepower does that give you, given the fact that most Series A focused funds are minimally $100 million? And if you're doing any type of late stage or private ventures or quasi-PE, your firepower or your powder has to be much greater than that to make any impact and do enough sufficient transactions.
Taimour.
Don't do Taimour me. I just asked a bunch of the Avengers, how much money would you want? The average number was 5 million. I said we're looking for 12 million. Oh, sorry, we're looking for 12 Avengers. So there's 60 million. I called Jeff. I said, Jeff, 60, will that work? He says, yes. I said, great, can I partner with your VCs? You guys raise 30, I'll raise 30. That was how we came up with the number 60. Am I open to doing more? Absolutely.
And can I add something? Maybe all of them are Series A, right? Let's assume. I know that having Series C have more chances to succeed, yeah? However, it's more risky in the amount of money you invest, right? So let's say, assume it's only A. please remember that it does not matter if it's A, B, or C, and it does not matter really if we will exit all of them or not by the end of 3 years. We want the data in order to build the platform. And that platform is the main issue here. Of course, we want to accelerate every startup and to see if it's possible to do it within 3 years or 4 years or 3 years and get some kind of an exit. Is it $1 billion or $100 million? I'm not sure. But at the same time, it's very important for us to build that, best practices platform. The faster it will work, it will enhance our ability to raise more funds, even for those companies, or get more companies inside within a year for Series B or C.
Can I just ask a different question? I apologize. Scott, can I just ask you something very quickly? How do I find Series Cs? I love Series Cs. How do I find Series C? I don't know, where do I call Jeff and say, hey, Jeff, do you know anybody who needs capital, but they're at the late stages? Like, I don't know, how do you find Series?
So generally, probably the right answer is it's subjective and it's going to vary. Now, there are statistics around kind of bracket ranges for each of the stages of, A, B, and C. And of course, with the recent pandemic, there's been a kind of a reset in terms of the valuation of those stages. So it's not a hard and fast rule per se, and some of that can also apply to cash flow, whether it's cash flow positive or not. You could have Series C or D that's not cash flow positive, but rather I think it's about appetite, institutional appetite, and the momentum that they have in terms of the next round. Sometimes in between series, there will be venture series that's kind of undefined, and it's kind of an intermediary aspect as well.
Got it. Thank you.
Thank you. I just wanted to add
there's one more thing that I wanted this group to think about is just practicality, which is if it's a fund structure, master and feeder fund structure with GPs and LPs, then you have to think in terms of, what is it going to look like? Is it a 220, 2% management fee and 20% carried interest? And within the 2% management fee, are you looking to divide between 12 GPs and then the analyst staff and administrative staff? And the same thing on the carried interest, aside from the money that you put in, on the carried interest, again, how is that going to get split? And if it's a $60 million fund, mathematically, is that even worth your time?
Those are excellent questions. Excellent questions. Those are excellent questions. Hey, Opher, I don't want to abuse the time we've asked for people. We've got 3 minutes to the top of the hour. Yeah. What would you like to take that would be, as a next step, would be inspiring, would move something forward like that?
Well, basically, we need the next action item. We had one more person on one of the calls, who was Dave Levinsky. And I think that Scott, I introduced you to him once, isn't it? I'm not sure. He has a company that they create business plans in Silicon Valley, highly successful. 90% of their business plans that they've created got funded, and we had a call with him, Taimour and I, and that was a part of it. He was excited about it. He had other model for us to do it. So he suggested some other model. He couldn't be on the call today, but we will see him again. What I suggest is to create, basically we started to write some paper about it with Jeff and Taimour. We can put this open to all of us to start to write questions and put suggestions in there. It's a Google Doc of some kind, okay? And try within 14 days to summarize the next steps that the group should take, and who are the people inside of it, and how we're gonna invite other people to be on that group, and with Jeff recommendations and other recommendations that we have, in order to be able to go to the next phase and define the plan for us for the next 90 days. What should we do, to build it, whether we do it or not, but we have to define a plan for the next 90 days. in order to put it up.
Yeah, thank you. Hey, Scott, if I may, my thought as a next step, if you're open to this, I certainly got a lot of value out of this call for me. I can't speak on behalf of Bill or Jeff or Opher. I would love to, if you're open to it, within the next, let's say, 2 weeks, if I can re-invite you to continue this conversation. Hopefully I'll have Josh on this as well, if that works for you, Scott. And then my secondary objective here is, Scott, I've got a sense of your background. I know a little bit about the things that Jeff is doing within the C-suite. And I don't have any commercial agendas between both of you guys, but my intuition feels that the two of you guys should connect outside of this call, because I think both of you guys can benefit from your, better word is network relationships. Sorry, I should say also, Scott, I also would recommend the same thing with you and Bill, if you guys are open to that. Not that
great,
Jeff
thank
needs
you.
more friends, but Jeff, I really think Scott's a super smart guy.
That's very apparent, Taimour. Scott, you've given us a lot to think about, and internally kind of processing everything that you were saying, because on one hand, as explained, the vision was molded in a specific manner, and now that manner has been able to kind of open up and expand quite significantly to a variety of different areas. And you got me thinking a lot here. So I want to thank you very much for your time. And I agree with Taimour, if there's an opportunity in the next short while to be able to jump on a call with you again, and hopefully we have a few more detailed answers that you might be able to take in and comment on. But I do appreciate what you've done. Thank you.
Thank you.
I'm just going to go 2 more minutes, abuse the time if I may, and I apologize for that. Jeff, I'm a little bit familiar with Scott and very even there than that into how he thinks. Jeff, if I may have a selfish agenda here, is I think if you talk about the C-suite with Scott outside of this call, the way that he connects dots, I think your council model, he may have a few ahas in that I think would be really cool.
Oh, cool. Yeah, we'd always be totally open to different ways of doing it. We're adding a few hundred councils right now, so it's moving pretty quick and fast. So I'd love to, especially, you know, we've all been thrown some curves a little bit with this Corona stuff, but by and large, you know, as